Welcome and thanks for joining our webinar on price and packaging for business-to-business software companies. My name is Ingvild Farstad and I'm heading the Operational Excellence team here at Viking Growth. Our role is to work shoulder to shoulder with our companies on initiatives to move the needle on growth. I like to think of us as the customer success department of Viking Growth, where we want to make sure that our customers, in this case our portfolio companies, are getting value from us beyond the money. After the webinar, we will open up for questions, so make sure you leave them in the chat as we go. All right, so before we dive into the main topic of today, pricing, I just want to give you some insight into Viking Growth on who we are and what we do. So Viking Growth is the leading software investor in the Nordics, and our sole focus is to help Nordic software companies scale internationally. Right now, we have 20 companies in our portfolio with offices and customers all over the world, especially in Europe and in the US. Our companies, they support critical work processes. Typically, they have about 3 million euros in ARR revenues when we invest, and they are looking for capital and knowledge on how to really take the next international move. We are a very hands-on investor, which is also the source for learning that I will share today. All right, so over to today's exciting topic and what I will cover in this webinar. We will give you insight into the importance of pricing and for a company on their growth trajectory, the AI questions we believe you must ask yourself, the analysis you should do to find the price model that fits your business, and lastly, our most important learnings from working with our portfolio companies. So let's get started. First of all, what we see is that pricing is a powerful but also underused growth lever for a B2B software company. Just to give you an example, as you see in this slide here, take a company having 100 million NOK in revenues with 10 million in EBITDA, so a 10% margin. So what happens then if you raise the prices by 20%? What you see here is that the revenue will go from 100 to 120 million NOK in revenues. And we also know that the overall cost will stay basically the same. So this means that the EBITDA jumps from 10 to 30, which is a 200% increase in profit. And that just not makes you a lot more robust company. It gives you money to keep fueling the growth. This can be used to improve your product, hire more salespeople, and also increasing your marketing effort. So it's not just about increasing the bottom line. It's about building a robust company for you and for your customers. We also know that pricing has a strong impact on valuation because pricing hits most of the most important SaaS KPIs. So what you see here on this slide is the Viking Growth KPI dashboard, which we use both strategically and operationally with our companies. And we use it for valuation for our own companies when we look at new companies, but also when we look at add-on acquisitions that we do. In a few weeks, my colleague Andreas will share our view on how we do valuation, an updated market view, and I definitely recommend you to sign on to that one. So back to pricing. So if we look at our own portfolio, pricing has been an important lever to offset the lower deal volumes, but also the slower new sales, which I'm guessing probably has been a challenge with you as well, with the market slowdown and then also having leaner go-to-market teams. So even if volume has gone down, what we see in our portfolio is that sharper focus on their ideal customers has led to higher average pricing for the new business, but also a stronger net revenue retention, and pricing has been core to that work. So it really matters also when times are tough. So how should you think when you're working with your price model? Ideally, your pricing should do two things. One, scale with the value customers are getting from your product. And 2, you should get a fair share of that value. Get that right, and pricing will become an even more important growth engine in your ARR bridge. So what you see on this slide is 3 different scenarios. On the far left, the ARR is disconnected with customer value. This is a typical scenario in the AI versus seats-based discussion that we're experiencing right now. A better product can mean fewer seats and therefore less revenue. We have had several examples of this in our portfolio, which has made us rethink our pricing. In the middle, ARR scales in the right direction, but you might be leaving money on the table. This is often a sign that pricing metric is correct, but the levels are too low. A good example of this might be the segmentation of your customers. So your smaller customer might be paying you too much, and then the bigger customers are not paying enough at all and are willing to pay a lot more. So what's important here is to find not price on the average customer, but really try to understand your customer base. On the far right, you see a model where value scales with the customer. Expansion is built into the model, and customers feel the price is fair because the return on investment is obvious. This is, of course, very simple to draw on this slide, but harder in real life. So here's the first tip that you need to take. What we see as a good first step is to map out what you're pricing on and map that against actual value drivers. Try to understand if the model you have sits far to the left or if it sits far to the right in terms of value for your customer, but also for you. And this matters as much in the AI era. Before getting into how you should choose your price model, I want to make a reflection on AI and pricing. For us, the core principle does not change with AI. You still need to deeply understand the value you create for your customers and what problems you're solving for them. But AI might change what you can price on and how you price it. For us, the fundamental question is, what's actually driving your customers to buy your software? Answer that and your pricing strategy will follow. In our companies, we see that AI, the maturity level of AI varies across our companies. And it's not just our companies, but it also varies across their customer base. Right now, everyone is talking about AI, but for most of us, we're still trying to figure out where does it generally create value, how do we deliver it, and how do we actually monetize it. What we believe and what Erik said in the webinar we had about AI is our software companies have a double advantage. 1, we can develop our solutions faster because of tools like Cursor, Claude, and so on. And 2, we can create even better solution built on years of customer data. And this is also important when you do the price model. There are 4 questions that you see on the slide here that we think all management teams of SaaS companies should be asking themselves right now. So 1, where can we improve our core solution or our core value proposition? Where can AI supercharge what you already do, making existing capabilities faster, more accurate, or more valuable? Number 2, how can AI increase adoption of your core solution? Where does your customer fail to get onboarded or fail to capture the value that you're providing? If you can fix the onboarding gaps or automate data input or surface insights so customers see value from day 1 or day 10 or day 30 and does not take them a year to see that value. And the reason I say this is that a common reason that customers don't renew and churn is not that the product is not good, it's just that they're not getting properly set up. Number 3, how can you expand your product offering? What is your customer's biggest unsolved problems, and how does that fit in what you're trying to deliver? And could you create something new for them? And the fourth one, how do we monetize pricing models? How does your pricing model need to evolve to reflect the new value and of course also the new cost that you're getting from delivering AI products or AI services? There is no single answer to this, but these are all important questions that you should ask yourself as management teams today. So how do you actually find your pricing model? I'll give you some examples of analysis we always do and that you should do. And we also have this pricing playbook on our website that I suggest that you check out, which has a lot more details to it. So there's three things that you need to understand. Your product's true value, I've said that many times already today. Your customers' willingness to pay, and your pricing power. There are typically 5 steps you can do to look at this and to get a better understanding of a good pricing model for your business. So the first one, I've already touched upon it, but segment your customer base by size, by geography, or by use case. As an example, we consistently see right now that the willingness to pay is a lot higher in the US than in Europe. We also see there's a big difference between your small customers and your big customers, as I already mentioned. So make sure you don't price the average, but price on your different customer segments. Second, and again, I know I'm repeating myself, but you need to understand the value you create, and you need to understand it from the customer's point of view. When we do this exercise, we try to make it as concrete examples on revenue gains they get from your solution, on cost gains they get, so saving cost, and also on risk avoidance, because these 3 things are good return on investments that the buyer on the other side needs to see either one of them or all 3. Third, identify the value drivers in your product, which means the specific features, capabilities, or outcome that your solution produce. And make sure to pressure test this view against your actual customers and data. So always talk with customers to get hands-on feedback. Just the last 2 points are, there's always hard to differentiate between value drivers and value creation. But you can look at value drivers as the costs. For example, automated invoice generation, payment reminders, integrations with other systems, or real-time data and dashboards. While value creation is the outcome. So, for example, the customers get paid faster for improved cash flow, which is a revenue gain. Or they spend less time on administration, which is a cost-saving gain, or reduce errors, which would be avoiding risk. So then you have some examples on that as well. And fourth, we look at the switching cost. In other words, how hard is it for your customers to change to an alternative solution? Mainly, we see this as a great exercise to build some internal confidence for your team, to really understand, oh, wow, it does take a lot of time to exchange our system for something else, and we do provide a lot of value. So again, a very good exercise to build confidence to do this as a team towards your customers. And then, while assessing the switching cost, you should also look at this combined with looking at your competitors and what they're pricing on and how they're pricing and the level they're pricing at. Because you need to understand your offering and you need to understand how you differentiate from your competitors. Knowing your customers gives you pricing power. And if you also have a clear differentiator, it gives you even more. So when this is done, then it's just all about gathering all the findings to decide on the right price metric for your model. And obviously, in an ideal world, you pick the metric that reflects the value the best. But again, we're working in a real world, so you also need to understand the buying behavior. So when you choose a metric or metrics, they have to make sense for your customers and maybe, or for the person who's buying it, and maybe soon also an AI agent, who knows. But it has to make sense for them because they're the ones asking for budget. They're the one they have to defend their spending internally, and they're the ones managing the users that's gonna end up using your solution. So the pricing model could be picture perfect, but in the end of the day, it's the customer's buying behavior that really determines if your price model works or not. So if you look at the right side here in this slide, I try to summarize it. So when we're selecting price metrics, we see that the key trade-offs is value alignment on one side versus measurability on the other side. And usually the service input, so seats being an example, is easier to measure than business output. Besides that, we see that criteria are scalability with customer usage, predictability for customers' budgeting, and also the customer's perceived value, as we've already mentioned today. In general, we see that hybrid model works the best right now, where you have the base subscription at the bottom, but then you have usage and outcome on top of that to provide predictability for both buyers and sellers, but also capturing the upside. All right, so lastly, I want to take you through some pitfalls and learnings that we've made together with our companies. Build a model that meets the buyer where they're at. So this is easier said than done, but the key here is simplicity. Does the customer know what they're buying and what they're paying for? If you're able to nail this, but at the same time push their thinking, you'll do great. And this is especially true when it comes to AI. Number 2, balance new sales and expansion. Successful packaging drives both new logo acquisition, but also growth tomorrow. It should be easy to sell today, and it should be easy to sell tomorrow. Number 3, predictability is key. For example, usage-only models that expose customers to big variances and hard to budget with reasonable confidence can create a lot of friction. On the other hand, pure subscription models could leave a lot of money on the table. So here you need to find a balance for both sides. And then aim for transparency and control. And this is especially true if the CFO is in the picture, or if you're a significant chunk in their cost base. And not the least, it should be easy for a champion to defend the invoice without them breaking any sweat. And then a few practical pointers. Start by auditing your existing customer contracts. What are current commitments, constraints, or your room for maneuver? And also make sure that you're set up for success going forward. And then license to operate. Make sure you're actually able to deliver what you're planning on packaging with your product. A price model only works if it works in practice. And then number 3, expect internal pushback. We see that the biggest resistance comes from within. So you need to involve sales, you need to involve customer success early in the process. And not just to take down the resistance, but also because they have a lot of knowledge, and at the end of the day, they are the ones who's going to sell your solution. And last but not least, start by testing price increases from day one. And I think you should push harder than what feels comfortable, because sharp customer feedback is the best way to figuring out what value you're providing your customers. And as an ending note, remember, pricing is not a one-time thing. It's something you need to do continuously to create more value for your business-to-business software company. Thank you for listening to our webinar, and let's get into the Q&A session.
Okay, thank you, Ingvild, for a great presentation on pricing. So now let's move on to some questions from the audience. So I've been following the chat during the webinar. We have some interesting questions here, but please feel free to put in more. If you have a question for Ingvild, type it in the chat and we'll take it one by one. So are you ready, Ingvild?
Yeah, let's do it.
Yes, good. So the first one here is, what are ways to figure out what customers actually value? Do you see differences between different customer segments?
Good question. I think let's do the first one first. So when we're looking at value, we try to to look at three sources basically. So we have the data source, which is looking at the usage data. What features are they using, functions, integrations do they have, services, support, and whatnot. And then we look at it from an internal view. So really asking the customer-facing employees, what do you think? And then also obviously talking to the customers. And the way we do it in practice and how I would go about it is to kind of list up all the functions and integrations and services and support and whatnot on a y-axis, and then on the x-axis we set up like do not need, nice to have, and must have, and then we map out all the three data sources that we have. So it's the data usage, the internal view, and then also the customer view, and try to see are there any differences between these three, and what's really on the must-have side of the matrix. So that's a great way of mapping out the value that you're driving, and also the value drivers from your solution.
Good answer, and some concrete tips there.
Yeah.
So the next one is more on the internal side. So how do you handle the internal pushback from sales on price increase?
Yeah, that's another good question, and I think a very important one, because I think the biggest pushback we always get when we do pricing is internal, and it's not and it's natural, right? Because you've done so much work to get these customers on board. You work together with them for a long time. You built a good relationship that you don't want to damage, and so it's very natural. But what we try to do is of course involve sales, customer success, and those who are close to the customers early, both in terms to get buy-in, of course, but even more because they have a lot of knowledge. So when you're building your model and you need it to cater for both new sales and also customer success, it's very important to involve them. And I think also what we try to do in this case is we try to build some confidence. And obviously the best confidence you get from not getting any feedback, or do the price increase and not getting feedback. But an exercise we do is kind of a switching cost exercise. So we try to map out what are the typical stages in switching to another solution, which could be evaluating a software, trying to figure out what software you want to buy, and then buying it, and then you need to configure this solution. You need to import the data, you need to train the users, you need to create the integrations, and then try to map out how much time does this really take. And in a lot of the cases we see that, or our companies see that, it takes actually a lot of time to get up and running on our solution, and the customers have done a lot of work to get there. So it's a good way to build confidence on that there is a high switching cost. So that's a way to do it.
Yeah. So involvement and analyze the switching costs.
Yeah.
Like some highlights there.
Yeah. And I guess it's not an exact science. That's usually the answer we get. So, but you can't put hours on configuration or on imported data. But it's not supposed to be exact science. It's just supposed to be like, okay, some hypothesis, and then you can try to test it. So yeah, build some confidence by doing that.
Good. And here is one from Snorre. What's your take on public prices, self-serve versus sales-led pricing, and how to create a bottom-up pricing ladder?
Oh wow!
Very specific.
Very specific question. Let me read it. Public prices, self-serve versus sales-led pricing, and how to create a bottom-up pricing ladder. Okay, I think you need to elaborate a little bit on that, Snorre, so I understand your question.
Okay. One here with Scott. What is your view on implementation costs versus ARR? Do most Viking companies focus primarily on ARR?
Yeah, that's also a great question, and it's a great way of that you can. Implementation costs is something you can use a lot in your negotiations. That's at least how we see it. So for a lot of our companies, the onboarding phase and implementation takes a long time, and it does cost you some money in hours. But what we see is we say, okay, we can do a lot of discounts on the implementation cost, and then try to keep up the ARR, which is also we see as a good way of in the negotiations with customers because then you can say, okay, but usually it costs us $50,000 to implement this software, but you can get half price or you can even give it away. So I would say what we typically do is try to say, okay, how much have a bottom line of how much money does it really cost us to do the implementation, to really map out what it takes in terms of hours spent and other costs, and then say, okay, this should be our bottom line of what we need to get from the implementation. But the price we put on top of that, we can use in our negotiations with our customers, and in some cases give it away. So it's a great lever to do when you're working on we're in the kind of the last phases of selling your solution to customers.
Good. If a customer is happy with an input-based pricing model, is it always positive to work toward a business impact pricing model, or should it stay understandable and predictable?
Yeah, I think that's it's kind of the question that sums up everything we're doing right now. So we're customers and us are used to the input-based models, and then we're moving towards outcome-based models. And right now, I think the maturity level kind of decides. But again, as I said in the webinar, I think if especially when one of the main stakeholders are the CFOs, then they want predictability. They want to know how to budget. They want to know how their cost line is going to evolve. They want to know liquidity. So you really need to balance this. And that's something we're looking into now and trying to find those hybrid models, basically with the base at the bottom, the subscription base, and then having some consumption or outcome base on top, because that also brings in predictability for you as a seller. Because you don't want your income to go all the way gone if they're not using your solution, right? So
it's very true.
Yeah, but it's a tough question, and I think it's going to evolve with the maturity level, and I think we really need to understand the buyer side of it and meet them where they're at, but at the same time educate them if we want to evolve our pricing model.
Good points. A lot of good questions here now. Have you seen price increases causing accelerated churn rates that could eat the benefits?
Okay, one more time.
So, have you seen price increases causing accelerated churn rates that could eat the benefits?
Yeah, and again, great question. I think really important to understand, okay, what value are we bringing to the table? And I would what we do, and based from learning, the last few years, we never say you're pricing on something that will come in the future. So always price on, when you're sending out the pricing letter, on what you've done the last months or years to really improve the product, and that's what you're pricing on. And then include things that's happening in the market. So it could be inflation, or it could be security level, GDPR, and now AI. But make sure that you price on things that's happened and what you've done. And then I think another important part there is actually do something, right? So don't evolve your pricing model, take up more money if the customer is not getting more value.
Very true.
Yeah. So, and that can be small changes, right? It doesn't always have to be those bigger changes with new products and whatnot. It could also be just UI changes, which helps the customer a lot in their day-to-day operations.
So communicate the value that they get.
Yeah,
basically.
and if what you've done and not what you're gonna do, because
Yes.
then they might churn. And again, talk to the customers, understand where they're at, and keep your hand on the pulse, as we say in Norway. I don't know if you say that in English, but you need to know what your customers are thinking, and dig deep into that.
Okay, here's a question on public customers.
Yeah.
So public customers like municipalities seem to prefer fixed subscriptions for budgeting. What is your experience with public customers, and how do you optimize the pricing model?
Yeah, I think that's we've done a few public. We have a few companies that have public customers, and it's definitely. We talked about segmenting your customer base in the webinar, and this is where you definitely need to segment between private customers and public customers. And with public customers, there's a lot of rules that you probably need to adjust to. And again, the consultancy answer is it depends. But what we've seen, at least in the different projects that we've done, is to really understand what are the threshold levels. Because a lot of the times you have a lot of room for maneuvering, more than you think you have. So really try to understand the contractual constraints, and if they're really constraints. I think that's it's a pretty generic answer, but the closest I get to having a real answer. You need to look at your contracts. You need to find out the constraints, and really understand, are they really constraints or not. And what we at least have figured out in for a few of our portfolio companies is that you are able to increase it more than you think. It's not kept at the level that we thought it were in the beginning. So that's I think that's my advice.
Look at the contracts closely.
Yeah. And again, if I were to expand on that, I would say that's one of the things we do in the beginning. So really try to understand the contractual constraints, because you might start a lot of analysis, you might start doing a lot on your price model, and it will come out in the end, this is how we're going to do it. And then you look at your contracts and we're like, okay, we're not able to do this, and either we have to cancel our contracts and write new ones, which we have done actually, but it might be good to understand those before you actually go into the pricing work.
See that time runs fast, so we actually don't have time for more questions now. But thank you, everyone. It was really good and a lot of questions. And Ingvild, for sharing all of your knowledge from the pricing projects that we've done with the portfolio.
Thank you. I think so I'll definitely have a look at the questions that we didn't have time for, and we can make sure that we try to answer them out either in written form or in another webinar. But thank you everyone for joining. It was it's been a pleasure to share our knowledge and to hear your questions and push our thinking as well. Thank you.
Thank you. That's it for today, and we have a new webinar coming up in just a few weeks. So follow up on that on our website, and thank you for watching today. Bye bye.